it can be difficult to figure out the proper timing when you are interested in a stock for fundamental reasons, but the technicals are not in alignment, and we're going to talk about that and have a specific stock to talk about today on Office Hours with Professor Mark Guthner of Rutgers. Hello, everybody, and welcome. I'm Mike Coe, and welcome, as always, to Professor Mark Guthner of Rutgers. It looks like he may be in his office this week. For those who were paying attention when we did the last office hours, they may have recognized that he was not in his office because the pipes froze with that cold weather that they had out on the East Coast. And apparently they're not allowed to be in the building when that happens, or they can't use the restrooms or something. But anyway, Mark, it's good to see you. How are you, my friend?
I'm doing well, and I'm pleased to report that the weather is much warmer at 48 degrees today. So
I think it might be the same temperature at where you are as it is where I am. So, I'm in Northern California, not exactly San Diego type weather, but usually it's pretty decent here, if a little bit grayer and a little bit wetter at this time of year. But we had some wild weather this morning. I mean, violent thunder, lightning, and supposedly hail in some areas. I don't think we saw any of that, and I'm happy about that because our cars were parked outside, our garage being full of all kinds of stuff. In any case, we, in one of our funds that we manage, we were short PayPal going into earnings, and this is a company that I rather liked. In fact, I think I may have even written an article in support of it fundamentally. We covered that short in PayPal. The stock is now, I think you pointed this out, it's back to its IPO price, is that right?
it's pretty close, within a buck or two, yeah.
And you had some thoughts about this one. Number one, you had some thoughts about how investors seem to be interpreting what they said when they reported earnings, and you had a little bit of a view on the company fundamentally. How do we reconcile how we feel about the fundamentals for a business where this thing is it's catching a little bit of a bid today, but I mean it's just below every long-term moving average. It's just hard to figure out when somebody should start thinking about doing something when there aren't a whole lot of technicals that would support it at this point, are there?
The technicals, well, I'm not sure. There's certainly not upward momentum. Let me do a little share on the price chart. There's no upward momentum. A lot of times I like to buy things.
That looks like the Burj Khalifa.
Yeah. It could be. So it's a little crazy when you look at this. Now, I think the company came public in the middle of 2016. And so I don't remember the price, but
2015, I think.
2015,
yeah.
right.
Yeah.
And I'm sure the Bloomberg will tell you, maybe it was $45 or something. And I had been watching it because I think they have a good business. Yeah, they have some competition because there are companies like Square, for example, that process transactions on websites and things like that, or have point of sale systems. But this is a company that has grown nicely. It's much bigger company today than it was when it came public, and so to justify the price way back in 2015, the world was giving it credit for a lot of growth that was going to take place. And revenues are up about 3x between then and now. So you've got all this growth that was priced in. So the growth actually manifested, right? And it's a much bigger company. It's 3 times bigger by revenue. And I got a little revenue chart here, so we could show that. How do I do that? Share.
I think it's up more than 3.5-fold because they have to, when companies report, they usually give out their financial statements for the periods leading into the IPO. So you don't have the same, you don't get the quarterly earnings releases or reports the way one normally would for a publicly traded business. But, there is some accompanying financial documents that typically accompany the IPO. And I think for the calendar year ended December 31st of 2015, the company did 9.248 billion
Okay.
in revenues and had adjusted EPS of $1.04 a share.
Yeah. Well, I didn't have access to 2015, so you're right. So a little bit more than three times. It has nice steady growth. One of the things that people did get a little shaken up by was the growth rate is slower, where it had been something more like 7 or 8% per year. It slowed down to, I think, to 4 and a half in terms of revenue. And they gave some guidance that there was going to be a little struggle on revenue growth in 2026. And then they shellacked the stock. This was trading at about $53 or something like that, or $50 at the time of their earnings, and then it just gapped down to about 41 bucks. Traded down, I think, as low as 38, and it's up today almost $4. So maybe the turn is here. But when I look at companies, I don't, you know, one thing that Wall Street is pretty bad at, I think, is they take whatever trend is happening in the short run and they pull out a straight edge and they kind of just say that's the way it's going to go forever. I look for companies that are going to grow, and I'm not particularly worried about fluctuations in the growth rate because products have a bit of a life cycle. Maybe they change product mix. Things can happen that make revenue growth rates in the short run fluctuate up and down. And so I don't particularly get worked up about that. And certainly in intrinsic valuation analysis doesn't really worry about that very much. Now, that said, that doesn't mean that that something's not going to happen in the marketplace when they announce a little slower earnings, a little slower guidance going forward, and then people, go out and take it out to the woodshed and rough it up a little bit. um, and that's what certainly happened to it. I thought that the beatdown was uncalled for, overdone, and probably the kind of a washout kind of sale event. And so I had written an article over at the Options Edge suggesting that people start to take a stab at it. So now the one last thing that I could show here is the earnings per share. So let's go take a look at that one. Earnings per share is continuing to work in the right direction. When you see a company lose, I don't know, 15% of its value, you would think something is like really wrong with the business. And it's not. So right now, the company is trading at about 7 times earnings. So that implies to me that the world thinks that this company is not going to grow anymore. And the way I interpret valuation models, because to get to a 7 PE, you've got to use a growth rate of 0 or maybe even a little bit, minus 1% or something. So now that doesn't help you in the short run, because anything can happen in the short run. There could be people who are in situations of forced liquidation because they made their bet with leverage. They've got maybe their whole portfolio is leveraged with a lot of different stocks, and they need to cut losses quick when they go down, and that causes a piling on effect with the share price. So in any event, I thought it was an interesting situation, and I thought when you talked earlier that okay, you guys were and your fund was short. Now, of course, I don't know what you guys are doing because I'm not supposed to know what you're doing. I wondered if there was anything that you could share us that kind of gave you what your thesis was on why the share price was not a particularly good buy at, let's say, $55 a share.
So yeah, our investment process, we have over 60 funds. I think we have 61 funds, including the foreign UCITS at this point. We have 2 discretionary funds that use options overlays against against a core basket of stocks. In one case, they're long, and the other case, they're short. The short fund doesn't manage a huge sum. The long fund is a little over $1 billion. But the short fund, and this makes sense. Shorting stocks is not easy. Stocks generally rise. The economy generally grows. I actually don't have as much to do with the process on the short side because I actually threw my hands up. I'm on the investment committee on the long side.
Okay.
And I am as well on the short side. But on the short side, one of the comments I made was, I've never been great at picking short stocks. I don't like it. Just as an exercise, it's not something I'm comfortable with. And the reason is because, to me, the principal reason that you would actually short a stock is because you know that there's actually something really wrong. And when I say something really wrong, I mean accounting irregularities, right? So, or fraudulent behavior. Or there's some existential risk that might be associated with their balance sheet. So one way to think about that is like the financial risks that are associated with, like Silicon Valley Bank, for example, would be. So that wasn't not a fraudulent business. It was a business that just didn't manage their risk very well, those types of things. But even in those cases, I'm aware of people who made short bets on those companies using options. And ultimately, if you can believe it, I have been approached by people who asked for help because they had made bearish bets on some of those institutions. The stock plummeted, it halted, and they were not allowed to exercise their puts.
Oh.
The brokers wouldn't. Yeah.
It's outrageous.
It is. It is. The rationale being how, if you can't get a locate on the stock, or if you had not already borrowed the shares, and they were no longer actually free to trade in the marketplace, how could you affect a short and then cover that short? So, when there's so much complexity associated with shorting stocks, and you just have a natural tailwind with being long stocks, right? So, given time, you can, as long as you don't pick really bad companies, you should be able to do okay. So I have also preferred, because when I was at Ivory, our investment mandate was deep dive, private equity approach to investing. You pick the best company in a space and identify the worst company in that same space, buy the best one, and sell the weakest, which actually sells very well as an approach. We had a very good investment team there, very good analysts. And I can think of at least one case where it made really good sense. And I've used this example. I think I've used it maybe during office hours. I certainly have in another live stream on at least one occasion. And we put on a trade, one of the earliest I remember, was in the Sprint affiliates. And the Sprint affiliates are companies that basically are all in the same business, but they just divided the country into geographic regions so that if you bought a Sprint phone or went to the Sprint store in Portland, Oregon, that would look exactly like the Sprint store in Portland, Maine, but there were actually different corporations that were doing that business, and those were the Sprint affiliates. The business was highly capital intensive. The business had to invest in updating their towers as you go from 3G to 4G. This was actually before 4G, but you get my point. As you update the technology, in fact, I think maybe we were still on analog. I'm trying to think when I was at Ivory, but we may have actually had still had analog mobile at that point. But these companies, because they needed so much capital, sometimes they would find themselves in distress. Sometimes they would go bankrupt. In at least one instance, one of them did go bankrupt, and it restructured. And after they restructured, they did another IPO. And we were given a look at the IPO, and we were able to purchase shares in that Sprint affiliate for approximately 30% of the valuation of any other of the then publicly traded Sprint affiliates. Wow. So pretty easy trade, right? So because they sell the exact same product on the exact same metrics, just different geographic locations, but you can adjust for that. And so we could buy Sprint and sell Sprint, and buy it at about a third of the valuation of where we were selling it. And that made a lot of sense. But there were other cases where it was very, very difficult to do this. And the example I often provide was this trade we had in Florida, Rock and Lafarge. Now, these companies don't exist as independent entities anymore. But as home building really took off in the Sun Belt, these companies, provided, basically the ingredients that you need for the cement companies, basically, right? And so, of course, they were very well positioned, right? And the beauty of these businesses is that this is not the kind of product that you can just decide you're going to import cheaply from China, because it's really not practical to import gravel and other things that you use to mix up concrete. So the challenge that we had, though, was that the PM that I was working for at the time said, look, he didn't want to short either one of them, because he said the business is just, it's a good business to be in, and it's good for everybody who's in it, right? They're building in Arizona, they are building in Florida, they're building all along the Sun Belt. And if you are in this business, it's just growing like a weed. You don't want to be short any of them. So ever since that time, I've had a kind of a distaste for shorting stocks in general. But let's just talk about the process. So at a high level, what is our process? We look for stocks that have positive momentum. That means that they're, if we're going to add a long name to the portfolio, it's going to be trading above a long-term moving average. We look for growth. So as I've often said, I like to see a company that is growing the top line as fast or faster than the S&P generally. The logic being that the S&P has solid top-line growth, better bottom-line growth as a function of productivity. Both of those are going to grow faster than the economy or inflation in most cases. And the S&P is naturally diversified. So in order to pick a stock that I want to buy, it has to look good relative to the S&P on several metrics, or otherwise I'm better off buying the S&P, because that's the way I think about it. Is you can allocate capital to the market by buying an index product, which is a fine idea. So if you're going to pick a stock, it better be better than fine. It has to be really good. So momentum, top line growth, bottom line growth, we like to see that growing faster than the CAGR for the S&P generally. So those numbers for me are usually going to be in the neighborhood of better than 4.5% on the top line and better than 8% on the bottom line. This isn't always the case, but that's sort of the general rule that I employ. I actually think I have the IPS up here somewhere. So for those who don't know, that's just the investment policy or process statement that the investment team uses. Now, our funds, probably like others, also have some other mandates. So you're trying to look for some diversification, not going to concentrate all in one space, which is going to end up, it's going to mean that you choose securities that don't necessarily rank highest on something like growth, but maybe you already own NVIDIA, maybe you already own Broadcom, maybe you already own some fast-growing stocks in a certain area. You need to focus on other areas, and there may be other sectors, other industries that simply aren't growing as fast. So you're going to try to get a little bit of diversification in there, and then we have a special sits carve out. I think the thinking on PayPal was, number one, it was clearly broken on a momentum perspective. So for the short fund, if you kind of take that long thesis and you invert it, then what are you looking for? You're looking for stocks that are trading below their long-term moving averages. You're looking for stocks that do not have exceptional growth, or where growth rates are slowing, and you might even think they're going to turn negative, right? So maybe the market doesn't give you a freebie by saying, okay, the company's already traded, we're seeing revenues declining by 4 or 5% per year, but it's still trading at 20 times earnings. So you got a chance to sell at those valuations. Usually on the short side, you kind of have to get a little bit ahead of the fundamentals, and maybe the technicals are your setup. So in PayPal's case, the idea was, I think that growth was slowing to maybe something less than GDP growth, which and this goes to a question I had for you, because when you were showing the revenue histogram that you had up
Hmm.
earlier, and maybe we can show that again, because I thought that was, I love that as a visual. Um, and you said, that you weren't particularly concerned because companies have periods of higher growth or lower growth, and that could be due to product cycles or new products and things like that. But PayPal is a financial, right? So when I look at companies that are in the financial space, I'm assuming that there's not too much consumer discretion in the product, right? Unless it's just falling out of favor relative to some other mechanism by which people could transact. So I guess my question for you is, how do you account for that? Now, right before we started doing this live stream, on the investment committee call, one of the things I said to the CIO and a couple of the other PMs was, at what level do we like PayPal? Because we covered the
Yeah.
short. So, and one of the interesting things that one of the other PMs said was, I think I liked it better when it was trading 60 than I do now. What he was referring to was not the fundamentals, not the valuation, but just the price action,
Yeah.
right? He just said it feels really heavy, but he absolutely is starting to think that, this might be an opportunity to start picking it up. So I guess my question now, that you have some sense of why we were short it. Everybody knows we've covered it at this point. That's actually, we file our positions overnight, so on T+1 everybody can see what these funds hold.
Right.
What you're thinking is on, how does one start to dip your toe in the water? Because you get a situation like this. This is my thinking, because it does seem so cheap. So when I say cheap, what am I looking at? I'm looking at cash flow, right? So this company has a lot of free cash flow, expected to do more than probably something in the neighborhood of 6.2 billion in free cash flow this year, and has no net debt. So I can't help but think, does an activist begin to play in here? Does another company look at the business and think maybe this is interesting? And if it does, that would, of course, create a situation where the stock snaps to some new level when that news is announced.
Yeah.
So that's kind of how I'm looking at this right now. What are your thoughts?
Well, mine is that the payments world is in fluctuation, right? Because um, there's more and more online businesses. So I think in time, PayPal is going to get their share of that business. Will they get more than their historical market share? I don't know. But they have an established product that works well, that is reasonably priced. And if you're going to build some agents or bots that need to get paid, and you need some kind of automated payment, they might be a company that you could work with. Um, so I don't see them as like their revenue growth rate turning negative, for some extended period of time. I think it's going to continue to grow. It's just a matter of how fast. The second is I know they're working on their own stable coin, and I see stable coins as a profitable business line. If you have a reason for the world to hold your stable coin. So these new stable coin issues that are going to come out, like from JP Morgan or the traditional banks or other fintech firms, have to are they how hard will it for them to take business from Tether and Circle? That's a little uncertain, but they're going to have a product there, and maybe they'll have this ecosystem that will give them a captured audience, perhaps. So I kind of see that as like a potential upside option. And on a pure valuation basis, if they're trading at about 7 or 8 times earnings, they've got a return on equity without growth of 12% or 13%. Any growth is a bonus for that. So over a long period of time, can I buy a stock that earns 15%, 18%? I'm going to like that, and I'm going to buy it when everybody else says I've had enough, I can't take this anymore, and they dump it. Um, so, I kind of think of markets a little bit as having some emotions. Like Ben Graham did. He says, just think of the market as your manic depressive uncle, and when he's like all upset and he wants to sell his
Yeah.
stocks, well, do him a favor and take it off his hands for him, and then when he's in a good mood and he's partying hard and he's enthusiastic, he wants to buy your stock, well, accommodate him again and sell it to him at a higher price. It's the old Ben Graham kind of thesis of the emotions that are in the market, and we see it a lot of times. We've been seeing this in Apple. Apple, on the one hand, trades at what, a 33 PE, 35 PE, something like that.
Let's take a look. Yeah,
Um,
I mean it's definitely at a valuation. I will say with respect to Apple that their operating performance was much better than I expected, um,
yeah.
especially on the top line. So we can kind of see that here. Let's
Oh,
see.
let me unshare.
No, you don't need to.
Okay.
Don't unshare. Just keep sharing your screen because the producers control what's on the screen,
Okay.
not you. But yeah, I mean, I was actually quite impressed because I had begun to believe that the top line. Granted, I recognize that there's a lot of services revenue at Apple, but I figured that net of their growth rate slowing in China, which apparently sort of picked up again.
Yeah.
I figured that, you had, they had picked up as much market share as they were going to. I didn't think they were going to start stealing market share. I figured you've got Android devices, you have Apple devices,
Yahweh.
Android seemingly more popular in Europe, and Apple arguably more attractive here. But in turn, I mean, you can take a look and you can see what's going on. And if you look at their last 12 months, I mean, their revenue growth was north of 10%
That's huge.
for the 12 months ended at the end of December. And their earnings growing even faster. And this is net of a lot of investors' concerns and frustration that they didn't seem to be monetizing AI.
Mm-hmm.
Well, these numbers suggest they don't need to. They're going to do something like 134 billion bucks in free cash flow for their entire fiscal year. Their fiscal year ends in September, and I mean that's phenomenal, right?
Yeah.
There's on one hand you can count the companies that are doing that. So but still the valuation for me is a little bit difficult to get one's arms around. And I'm perfectly comfortable owning Apple as one of the largest constituents of the S&P. It's not a stock I would pick to own.
Yeah.
Simply because if you're looking to pick stocks, you're looking for something extraordinary.
Mm-hmm.
Now, interestingly, PayPal could also be extraordinary simply because of its cheapness.
Yeah.
You will own other companies inside the S&P that are not trading at a single-digit multiple, and in this case, I mean, versus the full year 2026 numbers, we've got it's $41. You said it was 7, so yeah, it's in that neighborhood, maybe a little bit more than that now. Yeah, 7.6 times full year estimated earnings. And then when I say the full year, I mean this current year, which we're now almost 2 months into. Now, I don't know if I let everybody see this, but I think this is kind of interesting. So everything on the left here, these are the companies that supply PayPal, and everything on the right here, these are the companies that are customers of PayPal.
Mm-hmm.
And what's interesting is that I feel like part of what's weighing on them is this right here. You'll see that a lot of the businesses that they do business with, either that they buy from or that they sell to, have been underperforming lately. And you were talking about stable coins. I mean, is a large part of this weakness related to the crypto trade, you think?
It could have. They're having technical issues getting their stable coin to work, and it's not ready for prime time yet. So all I was saying is that's just something coming down the road. Uh, and so I thought that is a potential positive. Now, my point that I was trying to get to is if when you showed their historic growth rates, Apple's historic growth rates, we had a lot of years in a row where things were not very good. Here,
Mm-hmm.
down 2.8 up to 6.4. These are all less than nominal GDP numbers, that the number that you like, right?
Yep.
Um, and the um, it seemed to
It's
me
true.
that
It was actually
financial
much.
media was really negative on them because they hadn't announced something really fantastic in the AI space, and they're not giving any hints that there is something great coming down the pike on in
Hmm.
AI space. But then this is the way Apple has always done business. They've always been very secretive, and they do a sort of an explosive reveal when they've got a new product, and that may be something that's coming down the pike. But the point I wanted to make is all it took was one good quarter where they had better than expected revenue out of China, and lo and behold, everybody's back into the I love Apple mode. And it didn't take very much for them to switch gears. I think the same thing can happen with PayPal, that if they come out with a decent quarter, the next quarter, have some kind of turn around and kind of get back on their historic 7 to 8% growth rate. The stock pops back up to 50, $60 a share. Um,
Yeah, so this is actually also interesting because, when you have companies trading at valuations like this, you often see an enormous disconnect between the uh, the price that the street is looking for
hmm
and where the stock is currently trading. And yet, right now, we're not really seeing that. These numbers right here, I think are. I'm going to blow this up as
A lot of
well if I
holds.
can remember. Yeah,
They got a
which
fair number of buys.
is
Buys.
yes, but so I'm going to blow that up so everyone gets a good look at it. This is just to put things in perspective. This is actually quite a bearish number. When you have 12 buys, 31 holds, and 6 sells, that that's pretty remarkable. And the other thing I would say is, while the target price is 25%, not quite,
hmm
call it 22% higher than
Yep.
the current stock price, that seems like a good gap, and for some companies it would be. But what you often find is that these numbers are going to be closer. The average analyst target price and the last price are often going to be closer for stocks that are actually doing very well because, unsurprisingly, the street's having a hard time keeping up.
Yeah.
And so, when you start to see the gap between the average price target, that's over here, and the price of the stock widen, that's oftentimes an example that things are quite weak. And but as I look at this, I kind of do like the idea that right now everybody's on one side of the boat.
Yeah.
And you know what they say, when everybody is, it's like that scene in Caddyshack. I wish we had it, but there's um, Al Chervik, played by Rodney Dangerfield. He's out playing golf, and he has a phone inside his golf bag, and his broker calls him. And he picks it up, and just instinctively, his broker's calling. He's like, "Oh, bad news." He's like, "Sell, sell, sell." Everybody's selling, then buy, buy, buy.
Yeah.
A natural contrarian.
Yeah.
Um, and then the doctor wants to use the phone, and he said, "Is this long distance?" Because he was responding to his beeper. Anyway, it's a good scene in
Yeah.
Caddyshack.
The
Without
other
getting
thing
too
is I
distracted, but
wouldn't like this stock if it was at 22 PE and
mm-hmm.
this kind of noise. It's just that it seems to me the valuation is capturing a heck of a lot of bad news or potential bad news or fear of bad news. I don't know what you want to say. And that's why I kind of like it at this stage of the game now. Um,
It does seem so. So would one way to describe your sentiment on PayPal right now to say that it's so bad it's good?
yeah, you guys use that term quite a bit.
Yeah, that actually is something that Carter Worth says from time to time. I see that Steve Garcia. Good morning from rainy Marin County. Do you think it's time to sell, trim, reduce exposure, or completely close a long J&J position? It's up considerably. Well, let's have a look at J&J. Well, there was some other ones in here that I think we ought to get to as well.
Let's do.
But let's take a look. First of all, we'll just chart J&J, and we'll see what that looks like. It is a little bit extended relative to the 50 if we look at it here.
That's a beauty.
Yeah, so I'm going to actually look at this on a logarithmic basis and extend that chart a little bit further. And I'm just going to say, let's look at the 50-day alone. So just to see whether it might be a bit extended relative to its own averages longer term and see what this looks like. Well, the first thing I would say is that it does appear that there have been moments in the past when it stayed well above its moving averages for quite some time. So I don't know that that necessarily tells us anything too important.
Can your can your program, can Bloomberg like overlay a PE ratio on top of this chart or anything?
I can. They changed that function. I used to love to use it. They had GE, which allowed me to graph basically the fundamentals. And they changed that function to GF for graph fundamentals, I think is what the GF stands for, which is nice. So that's the good news. The bad news is the way it works, I have not gotten to a place where I'm super comfortable with it. But let's do this, and I'm gonna lose the. I don't think we need to see the
revenue
earnings, and we don't. Well, yeah,
it was earnings per share. Oh no, you didn't. Earnings per share.
No,
PE.
I'm just gonna do the price to earnings ratio, so we can look at these things in isolation, and we'll look at it. And as you can see here, it's trading at 23.7, which is not as high as it has been.
But it's above the average.
It was higher in this area here. But as we think about that, so let's just draw...
it's above average, though, for sure.
Oh, yeah, for sure. So just draw a picture in your mind's eye there. And now, so what I always do, I'll look at this chart to give me the time series. And then if I see an area in the past that looks like it was anomalous, as that period was, I immediately say, okay, well, what was going on then? Was this just exuberance in the market, or was there something else going on? Now, I immediately suspect there was something else going on. And why? Because look when the number exploded the last time. Look when that took place. That was 2020. So let's take a look at 2020 and see if something funny went on. There was obviously a big health scare going on. They were doing, Johnson & Johnson. They spun off all of their. Is it Kenvue now that has all of their? Yeah. So let's go back to 2020.
Then somebody's going to buy Kenvue, aren't they?
Yeah, I believe we're going to take a look at that in a second. So yes, so here's what we can see, and this I think is really important. So as we look to that period of time, notice that in late 2022 you had a big year-on-year revenue decline. And you'll also notice that during 2020, earnings fell from the prior year. So it was 732, and you had a decline of a 7% year-on-year adjusted EPS decline. Actually, I didn't need to do that calculation because it's right below.
It's interesting, and revenues barely budged.
And then, of course, they recovered and sort of came back to trend. So as we go back to that, and actually...
but the market cap exploded.
Yeah, so and you can see that here. The revenues were basically consistent, but this now we can sort of get a better sense for this choppiness, what was going on there, and this makes some sense, right? So you have a situation where EPS goes down to a local low, and that is a local low, by the way. See, that happened right there in 2020. And of course, correspondingly, this, which is the trailing PE, see how it's LTM, last 12 months, just so as everybody's following along at home, that the valuation would spike, of course, because you would have got this number fell, we would have gotten that number, and then that would be a trailing number embedded into this.
Yeah.
We can actually get the, I think, forward PE right here. I'm going to hide this one. And sometimes this number will be a little bit more sensible. And the reason is because people tend to look through. And if you look at it this way, and again, I'm going to hide this because it's clouding things. And if you look at things this way, you can see that indeed it did get relatively high in 2020, but it was nowhere near the all-time highs. I mean, it was just 5 years, within the prior 5 years, it had been higher. So the street was kind of looking through the pandemic at that point. But what is also interesting is look where we are now. Right now, we are at 10-year highs in terms of the multiple to forward earnings as far as J&J is concerned. Okay, so is there a reason on that basis to say, well, maybe now's the time to take profits or some profits? That would suggest yes to me.
Yeah, I think it does.
Technically, nothing is saying sell except for the Rex oscillator, whatever that is. I don't know what the Rex oscillator is, and that thing.
The trend is your friend.
Trend is your friend. I'm not crazy about technical indicators that transact as frequently as this.
No,
it's just not for me.
It keeps your friendly neighborhood broker in business.
Yeah, I should go to the sell side, and then I'll, say I have a boat payment. That was you ever listen to Click and Clack? Tom and Ray Miazzi, from the the radio show on NPR called Car Talk.
Yeah.
Unfortunately, one of the brothers died, but they would always joke about that, when unnecessary works, because they were mechanics. One of them was also an MIT trained engineer, but they would.
Yeah, you'd never know it by listening to the show. I mean, they knew what they were talking about, but they were real jokesters.
Yeah, but they would joke about, unnecessary work in the shop because they would say they had, that the mechanic had a boat payment he needed to make. So the severity of your car's ailments was directly correlated with boat payments by the mechanics.
That's funny.
So here's my thinking on J&J. The valuation is high. Higher than it is to itself, or as high as it has been to itself in 10 years. And it's not like the last 10 years have been an era of particularly low equity valuations in general. So that's one of the comments I would make. But kind of to Mark's point, the trend being your friend, if you have nice gains in it, chances are it has outperformed some other holdings. Well, maybe it has, maybe it hasn't. Depends on what else you've been invested in. One of the things that you can do is you can naturally rebalance your portfolio when big winners just become, excessive, right?
They got outsized exposure.
Yeah,
in
they
your
get
portfolio.
outsized relative. Yeah,
No.
if you had bought silver 24 months ago, for example, and you were really high conviction. What would a high conviction allocation look like? So you took 10% of your portfolio and you dropped it into silver 18 months ago. Well, assuming that the rest of your portfolio behaved like the S&P, by the beginning of February, your silver position would have been enormous because silver had actually gone up by triple digits by that time. So what had started as 10% of your portfolio might now be 25. If you were rebalancing, you might say, well, having a quarter of my entire liquid net worth in silver might be a little risky, especially as its volatility increased. Maybe you can speak to this. So there are a lot of people who adjust their portfolios just based on arbitrary concentration limits. There are a lot of portfolio managers who assess their position's size based on risk. So they use a risk adjustment. And as the volatility of an asset increases, they therefore assume that the risk of that asset increases, and they would therefore downsize their position. So for two reasons, one, silver was getting more volatile, and two, it would have been got huge in your portfolio. There'd be reasons to pair it. Such would be the case in Johnson & Johnson possibly, except it's not getting volatile. So maybe a slight adjustment. What would be your trigger to sell if you had something that was winning like this?
If it was winning like this, I might be tempted to take some of my portfolio and write calls against it, out of the money calls.
Not a high volatility stock,
but
though,
it's
Johnson
not.
and
But
Johnson.
or maybe just sit back and do nothing, and let it go
Well,
until
look
you
at
see
this,
it turn
actually.
down.
Look, this actually comes as a bit of a surprise to me.
Um,
The implied volatility is actually, look at this.
higher than normal.
Yeah, so that might not be a bad idea.
That would be one thing I would consider. You know what pension funds do is, at least once a year, they've got a strategic asset allocation where they've got a long-term balance between stocks, bonds, and real estate. And if one massively outperforms throughout the year, you would take money from the winner and put it in the loser. A lot of times that means, because stocks go up more than bonds, that you're kind of taking some money away from stocks and putting it in bonds when it goes way up. And that means that you're going to have plenty of firepower if stocks turn around and get hammered. And now you can take money out of bonds and put it into stocks at lower prices. So they have that's called strategic asset allocation. Then they've got tactical asset allocation, where they're going like, well, given the fact that the economy is growing at more than 4%, I think that the number was 4.4 the last year. Maybe we have a little higher than normal equity exposure in our account. So what am I getting at? What am I getting at? If his position went from, let's say, 5 to 10% of his portfolio, he probably doesn't need to lighten up very much. But if he just went from 10 to 20, or higher than that, then it probably makes some sense to take some chips off the table.
So how do you feel about Palo Alto Networks here? FinWest is asking us about it. They are going to be reporting after the close today. So in an hour, only an hour and 15 minutes of trading remaining. Stock's a little bit weak today.
The things that,
or actually, I mean, it's down 2%, right? So it's actually more than a little weak. What are your thoughts on Palo Alto?
The idea that Palo Alto is sort of like a stable infrastructure kind of name, helping the internet do its business. The bulls on Palo Alto think that there's going to be a bigger spend because a lot more data is going to be moving between data centers. And so they need more fiber optic, they need faster routers, etc. Is that happening now in real time? I don't know. I don't know what kind of excess capacity there is in the internet. And does there need to be an additional build for a potential bottleneck somewhere? That's what I don't know. It's all I've read about what people seem to think about the network stocks is a lot more data is going to be flying around the internet, going between data centers. And it's going to be, and Palo Alto, amongst others, is going to be a beneficiary.
Let me ask you this question, Professor. Hypothetical company makes widgets. Hypothetical company is going to grow the top line at 13% next year, and it is going to grow adjusted EPS by about 13% next year. Let's assume, for the sake of argument, that that's consistent with the growth rate that it achieved in the year that we are currently in.
Okay.
As you extrapolate that number out, so 13% top and bottom line growth, and yeah, so we'll just start there. what do you think would be a reasonable valuation to throw on that business? So it's going to have,
Well, the way I think about this is I do a variable growth rate, because if I thought it's going to be 13% forever, then price doesn't really matter, because that growth rate is in excess of their cost of equity capital, probably, or about the same.
mm-hmm,
So the company is
yep,
worth a shit ton of money. Um,
mm-hmm,
but what I'd normally do is say, well, how long are they going to have this above normal growth? And then how long is it going to take to go down to sort of traditional growth, or growth relative to GDP?
mm-hmm.
And that's the steps that I would follow. Make a little spreadsheet, then use some kind of long-term growth rate to get a terminal value, let's say 10 years into the future, and then discount the cash flows back. That's the exercise we go through in our class. And so it really
Let's, on
depends
a
how long
variable
that
growth,
13% is.
back of the napkin, let's just say that it reverts to the growth rate of, call it, the S&P in 5 years, 60 months.
And then you probably
So
want a
you
PE
have
of around 30 or higher, maybe 33, something like that, because the S&P 500 is trading at what, a high 20s,
S&P is in the mid 20s, I
mid
think, at this
20s.
point on a forward
So if
basis.
the growth rate's a little bit faster than the
Mm-hmm.
S&P, then yeah, the PE should be a little bit higher. So
So with that in mind,
go
I'll
to 30.
pop this screen. Well, pop this screen in, and we'll take a quick peek. So we're going to just think a little bit about two things now. The first is, what is the market's growth expectations? So it's done about 15% over the last 12 months. The expectations are that it's going to dip only to less than 10 for
Yeah,
the calendar year ended July
yeah,
2029.
that's
So over
true.
the course of the next 5 years, it's looking at low double digits, which is considerably faster than the S&P.
Mm-hmm.
It
Yeah,
is also suggesting I don't, this is a very funny one, right? So they're saying, oh, for the fiscal year ended July 2029, we're actually expecting EPS to go down by 2 cents, but thereafter it's going to rebound
yeah.
and have 11%. Now this is kind of funny. Why is it funny? Well, I mean, these are all, I'm not going to call them complete thumb in the wind calculations,
Mm-hmm.
but there's, obviously a lot of estimating going on. So the notion that you have these degrees of precision, like, oh, $4.89 a share, looking
Yeah.
3 years hence, 3.5 years hence, that's really not all that realistic. So where we come down to is, if your variable growth analysis, Finwest, because you were the one that asked the question, actually is that it reverts to mean growth rates within the next 5 years, mean being what we had largely talked about, which is this is what the S&P is growing at, then your multiple, a reasonable multiple, might be 30 to 32 times. Wouldn't
Yeah.
you agree with
I,
that?
I
Yeah.
would, yeah.
Yeah. So that would say, and we're looking at, for the full year, I should actually put this to quarters so we can do this, because otherwise we're going to, so I'll do it like this. And that would mean full year would get us to, that is, well, in round numbers is $4,
Mm-hmm.
right? So $4 times 32, that gets us to, $128, $130. It's trading 163.60.
Wow.
So that now, if by contrast you happen to feel that the assumptions that the analysts have made going out 5 years hence are actually correct, I would say it is reasonably valued, because they're forecasting growth over the next 5 years of close to 10%
Yeah.
plus a year.
Yeah.
And that doesn't seem wholly unreasonable. So the question is, do you think it's going to, in terms of your valuation analysis, here's the question. Do you believe these numbers? Do you think it's going to grow at least 10 and possibly as much as 14% year on year over the next 5 years? If you do, the valuation, I think, is quite reasonable. If you think it's some number less than that, then arguably the share price should also be less than this.
Yeah.
So I hope that helps. That's, a little waffly, and now that you got 66 minutes to make your decision, before you gotta find out what
Yeah.
what this next number is going to be. Let's just, oh, you know what? We might as well take a look at this so that we have some sense of it. So, consensus adjusted EPS numbers are 94 cents a share. What I like to look at is, have people's estimates been going higher or lower? And as we look here,
Inching.
so I guess my immediate question is, why is the Q3 number lower than the Q2 number? See?
Yeah.
So the orange is below blue. So it's basically, because I thought basically everybody's throwing money at the problem, and that expected number was just growing and growing. But 94 cents a share is what the street is looking for. And it doesn't look like anybody has reduced that estimate of late. If I had seen this start to trend down at any point within the last 3 months, I'd get a lot more anxious. And that's because, people are taking a read on these numbers by seeing what everybody else is doing. What are people actually spending? And then they can kind of model out how much of that finds its way down to Palo Alto. So the good news, or actually has there been?
Well, this is kind of, so what does it have? A PE
Actually,
in the low to mid 40s right now then?
It's like 37 times forward, 38 times forward. Actually, there was, somebody did actually cut their number. Look at that.
But given those growth rates and given the thesis that I just put out there, this is certainly not a short. And if you owned it, you've been writing it up. I would be tempted to just let it ride through earnings. I wouldn't necessarily, if this were my position, I wouldn't be selling it before earnings.
Okay, there we are. Do you see how I blew that up a little bit? I just wanted people to, so, I mean, there's a lot of people who are covering it. So actually, there have been some so the consensus actually has dropped a little. I mean, a really little.
Yeah, that's,
I mean,
what
was it here?
I wouldn't, that's a distinction without a difference.
Yeah, pretty much. But, yeah. So, and what about vol? Is this one just so sell some premium against? Maybe.
I'm going to guess it's 45-ish, 50.
50. Woohoo! That's, how about 2-month vol? That's in the 40s.
Yeah, well, it's going to be a little higher for
average.
the shorter one because you got the vol premium for the earnings.
Yeah, no, but I'm trying to figure out, do you get to capitalize on a little bit of vol crush? So these numbers down here, let me get rid of the price so everybody gets a good look. So the question is, stock's down a bit. You can sell 2-month premium over here, and typically after the print comes out, it ends up down here. That's a pretty good vol suck, pretty good vol crush.
Yeah.
And pretty metronomic. It happens with pretty good regularity. So, if you own it, maybe sell a little bit of premium against it. Partial position it. You could, if you have a partial position, you could sell some short strangles maybe. Bearing in mind, and I think everybody should bear this in mind, that we have seen a couple, including PayPal, which we started the whole conversation on anyway. Some of these stocks have moved really sharply off of earnings. I think how did Salesforce do? I think that was another one that we had on the short side. That obviously worked out well. We took that one off. And Roblox. So, I see. So, Finwest is saying I don't own Palo Alto Networks. It's just merely an earnings trade. So, yeah, I mean, to me, it looks like I'm kind of intrigued by the idea of selling a little bit of premium against it. I think it looks pretty fully valued from my perspective at 37 to 40. Yeah. So I wouldn't mind selling off a little bit of upside, but that's just me. Monday morning quarterback, heavy rain in Orinda too. Does Mark like the miners now? He's got BHP, Rio, Vale.
Yeah, I like BHP. I like all those guys because I think we're in a secular move now where mining stocks are as. Who is it that used to say buy things that hurt when you drop them on your feet? Um,
Dennis.
yeah,
Dennis
Gartman
Gartman.
used to talk about that. He was always
Hmm.
a big mining guy. And
I like to buy things that when you drop it on your foot, it hurts.
yeah. Um,
Real assets, in other
yeah,
words. He didn't like,
yeah. He was a little
you know.
before his time. Yeah,
Yeah, as the producer just said, that line from Jurassic Park when the kid finds the goggles inside the glove compartment of the electric vehicle when the car stopped driving, and he's got these infrared goggles and he's looking around, and the lawyer says to him, "Are those heavy?" And kid said, "Yes." He said, "Then they're expensive. Put them down."
yeah. It's
um,
nice how the lawyer got eaten in that one.
uh, yeah, I remember. Didn't he run into the
Yeah,
outhouse? Um,
gotta go. You gotta go.
yeah,
That's right. That was Jeff Goldblum's line.
Yeah, when you gotta go, you gotta go. When it's your time to go, I guess. Although the interesting thing is that if I'm trying to remember what that outhouse looked like, but for some reason I remember the park being very fancy and spare no expense. I think was what
Yeah.
Mr. Hammond or whatever his name was kept saying, and somehow I don't remember that
That was more like
facility
something you'd find
being.
on Gilligan's Island.
Yeah, it didn't seem all that impressive. So Jen K, by the way, who made a comment earlier, she's in Burbank. He. I'm assuming that's a she, but forgive me if I got that one wrong. Says I'm in Burbank and it's around 50 and on and off rain all day. I will tell you that the most violent thunderstorm I've ever been in was in Burbank.
Hmm.
There was a basically a benefit, and they have a golf club there. Um, that I'm trying to remember what the name of it is, but it's pretty well known. I remember in the locker room they had the names of all the old celebrities that, like Bob Hope and people like that were on the locker doors, and it was a benefit for childhood epilepsy, and we were out on the golf course, and Los Angeles just. You don't really think about the weather very
No.
often. There was that movie with Steve Martin. You grew up in Los Angeles,
Yeah.
so you know this. And you just don't. It's not something you think about all that often. Out on the golf course, and then all of a sudden, the most violent thunder and lightning. I mean, running for your life off the golf course, lightning striking. It was just insane. And I had just come in. I was living on the west side. That's where our offices were at the time. So I'd just come up and over and into the valley, and wow. So hopefully you don't get any of that kind of crazy weather down there, Jen. We had some pretty violent thunder and lightning today. It's also uncommon up here in San Francisco, but we do get it.
Yeah.
Today is an example. Okay, so we have chewed up an hour of your time and mine and everybody watching, and we appreciate your comments and your questions. Hopefully we answer them just glancing. So Vale and the other miners, yes, we own Southern Copper for what it's worth. Stephen, trying to squeak one in under the wire. Carvana. What do you think about Carvana?
Carvana, I don't understand how it went from what $3 to $400. Yeah, they had a turnaround in earnings, but the business model's a little. I don't know how you automate a lot of this because you've got to do so much with the DMV. That it. I mean, it's a great idea, but I don't know if I don't know enough about their operating procedures to say is it really going to work in the long term. And there's so much controversy about the company on various financial websites that it's enough to keep me from ever buying the stock. If I'm not going to buy it at $3 for like a throwaway trade, I'm certainly not going to buy it here.
So yeah, I mean this is a really interesting business. First of all, they have a lot of non-arm's length transactions.
Yeah, that's one of the
So the
things that.
Garcia so the Garcia family, Carvana, they have a finance company arm that's not part of the entity, but they have a lot of, I guess they're related party transactions, the company is willing to, uh, pay up handsomely for the secondhand cars that they buy in
Yeah.
inventory, and they sell them at competitive prices and on good terms, it should be said, for the buyers.
Hmm.
I myself have done business with Carvana. I sold a vehicle to them in Austin.
Oh, cool.
They made an offer that I could not refuse many years ago, and I got to see one of their vending machines.
Oh, cool.
I spoke to the co-founder of a startup here who was a former investment banker, and he and a bunch of his recent Stanford MBA graduates have set up a company that in large part it's supposed to focus on EVs, but they are very impressed with Carvana's model. What is Carvana's business model? They are not a car dealership. They are a finance company. So the way this business really operates is that they are very heavily in the subprime lending space,
Oh.
effectively. Well, I mean, and that's not a negative, right? So you
A
could
lot
be
of
a home
people, yeah,
builder, and
are in that
you
kind
could
of
be a
shape.
home builder and make no money on the house and make all of the money on the mortgages for those houses. That's okay.
A lot of car dealerships
Um,
operate this way. The bulk of the money is made for financing and aftermarket, and they only get a
Well, yeah, that's right. So I think it's important to understand, because if you take a look at this company and then you compare them to other dealerships, and there are a lot of publicly traded dealerships. Penske is publicly traded. CarMax is publicly traded. And these businesses, all to extents larger and smaller, make a combination of their money on the net profit per vehicle sold, the financing, if the company offers maintenance and things like that, which Carvana does not really, it could be on that area. It is a business that they've done something really remarkable here. I actually thought there was a risk that they were going to go out, because at one point they had very significant negative free cash flow.
Yeah.
They had a lot of inventory that I think they were probably upside down on at one point, because they had accumulated huge amounts of inventory in the demand for used cars skyrocketed coming out of the pandemic. I mean, a lot of production was going down, rates were exceptionally low, and then as rates shot up, lo and behold, things got a lot less attractive because car payments started going up. So I think they did a masterful job, frankly, bouncing off the bottom. But I am with you. This is not. This one's not for me. As good a job as I think they have done, and they have done a good one. And if we're looking for no other reason, how about this one? Just technically, it's not in a good spot.
Yeah,
so,
looks like a little double top there.
And yeah, I mean, we can close in on this way, but we've broken through all of the moving averages.
Yeah.
And it just seems, technically it feels heavy to me.
Yeah, stay out of the way.
And so I would be very surprised, regardless of how you feel about their business. And no, I'm not casting any judgments on it like some do, because the CEO's father, there were some issues, which I'll allow anybody else to go investigate. But Garcia Sr., who started their sort of conventional car dealership business, he had a couple instances in the past that I think have a little bit of hair on them, shall we say. And probably somebody on the production staff can find some of those specifics. But yeah, I would probably wait for a better opportunity here. And I will say that I'm not hugely enamored of the subprime space in the auto area, because I think these consumers are among the most stretched or stressed. But I would also offer the following, which is that economic data has, over the last couple months, a couple quarters really, been better than I thought. I actually went into 2025 feeling pretty concerned about the indebted consumer, cash balances, employment growth seemed to have stagnated, and I was worried in an economy that's 70% consumer driven that we might run into a little bit of trouble.
Yeah.
And yet the consumer data has, through it all, been better, wouldn't you say?
Yeah.
Than I think a lot of people predicted, than most people predicted.
It is. Well, they've been
myself
hanging
included.
on. I saw a listened to, was it a podcast or just something I read that there's now sort of an acceleration of houses in foreclosure, that there's over 40,000 houses in foreclosure. That process takes a while.
Yeah.
You're
There's
dealing.
a house near me that's been I always get the auction notifications,
Yeah.
and I've been getting them for this house that I can actually see from my front yard. Um, it's been on the block for the last 6 years.
Nice.
Like they always at the last minute they somehow pull it back from the brink. So courthouse steps gonna be auctioned, and it just never happens.
That's crazy.
I don't know what's going on. I've seen that a couple of times, but their lawyers come forward and they have one last trick to pull, and I don't like to see people get thrown out of their house.
No,
so,
of course not.
I'm not sure that's a great solution for the lender, but I haven't really delved into it. Okay, well, for those of you guys who tuned in, we really appreciate it, and we hope that you'll tune in for the next one. Mark, are you available this time next week?
Yeah, I'm good for Tuesday next week.
Outstanding. I think I am as well. So 2 o'clock Eastern time on Tuesday. Please come back, tune in for another Office Hours. Professor Mark Guthner of Rutgers. As always, thank you very much. We really appreciate it.
Holy cow, what's that?
Now, where does he think he's going? When you gotta go, you gotta go.